Make your HSA and IRA on steroids. It's a great day because I don't have any appointments today, and so I'm able to catch up on a lot of my videos that I've been piling up. People send me just a ton of great stuff, and it just sits there piling up until I kind of clean up my, I hate to say it like this, but clean up my client list. And I got some downtime, which I can focus on some of these videos I've been wanting to do. And then I'll build up my client list again and not do as many videos. But today's one of those days, one of those few days where I got no appointments. Just knock out a bunch of stuff, knock out a bunch of videos, and share it with you. And I appreciate all the people who email me this stuff too. There's a lot of this stuff. It's either redundant, not a lot. Some of the stuff's redundant. I'll delete it. I don't have the time to respond to everybody, unfortunately. But I appreciate you sending it. If I just delete it, it means I've already either done a video or it doesn't interest me that much. And please don't take that offensive. I just, I literally have a stack of email. Hey, look at this article, look at that article I want to get to. So, hey, buddy, what's up? And you can hear Pablo over there looking out the window. I'm not sure what's going on. All right. Dateline, July 25th, 2019 from Evan Bettel, a CFP, who's with, I'm not sure who he's with, but this is, Bettel Financial. There you go. All right, actually, all right, I'm asking, please, Evan, have your fees on here. Let's see. Comprehensive Wealth Management, multi-generational FAQ. Are you a fiduciary? What service do you offer? How am I billed? Do you have a minimum portfolio? How do you charge and how much? Okay, you going to answer that? Yes, he does. Good. Okay. At least he has his fees on here. So he charges 1.05 on the first $1 million. So I'm not a fan. And a minimum fee of $500,000, $5,000. Excuse me. All right. So I'm not a big fan of that. All right. Anyway. Oh well. So read the article, and I don't like that. Or we're a fiduciary. I just, man, you gotta, man. Whatever. That's too bad. I was hoping he wouldn't have an asset under management fees, but just real quick, I gotta say, the fiduciary conflict of interest, are you independent? I mean, all these questions, no one actually asked that. I mean, I guess someone might say, are you a fiduciary? No one actually says, hey, do you have any conflicts of interest? Because he's not gonna, the only reason they put that on an FAQ is because it makes themselves look good. I inherently have a conflict of interest when you charge an assets under management fee. I mean, it's inherent. That's okay. But I hate these FAQs like, are you a fiduciary? What does fee only mean? Let's take what it says. Fee only mean, do I receive any type of commission? As if that's neither good nor bad. But anyway, let's read the article. What if I told you a health savings account is the most tax efficient and versatile retirement account you own? And believe it or not, with proper planning, an HSA can blow away the doors of your 401k, IRA, or even Roth. When we think about HSAs, we think about a tax efficient pass-through vehicle that allows us to make tax deductible contributions followed by tax-free distributions, reimbursing ourselves for qualified medical expenses. However, one of the HSA rules often overlooked is the ability for someone to reimburse themselves for medical expenses that were incurred in prior years. This special rule allows for a unique planning strategy. Who qualifies for an HSA? You have to be a participant in a high deductible health plan, HDHP. The HDHP will have a lower premium than traditional health insurance, but you will be required to pay more out of pocket, at least on the front end. Thus is high deductible. The 2019 maximum HSA contribution is for an individual $3,500 or $7,000 for a family. An additional catch-up contribution can be made for those 55 years or older. Distributions can be made tax-free for qualified medical expenses such as policy deductibles and copays, as well as dental, vision, and hearing care expenses, even if they're not covered by health insurance. The dental stuff is a big deal. Because, like I said, 4 kids, all 4 getting braces, that's a big deal. Any distributions from expenses other than qualified medical expenses will be taxable plus a 20% penalty will apply. This rule changes at age 65 when the 20% penalty goes away. See, I didn't know that. That's interesting. Good stuff, Eric. So the 20% penalty goes away at the age of 65. Still got to pay tax on it, but that's not so bad, man. That's not so bad. For this strategy to work, you must be able to pay out-of-pocket medical expenses from your cash flow or sources other than your HSA. You must be able to pay out-of-pocket medical from your cash flow or sources other than your HSA. So here's an example. Phyllis is a 40-year-old with a high deductible health plan and plans to retire at 65. For the next 25 years, she'll make tax-deductible contributions of $6,500 to her HSA. She does not request reimbursement from the HSA for her family's medical expenses, but maintains all receipts. If we assume that out-of-pocket qualified medical expenses equal $8,000 per year, the 25 total would be $200,000. She invests her tax-deductible contributions in her HSA using a long-term growth strategy. We'll say she has an 8% rate of return, and then her account balance will be $475,000 after 25 years. At the age of 65, she retires with $475,000 in an HSA and begins making tax-free withdrawals as reimbursement for $200,000 in medical expenses paid out of pocket during the last 25 years. So she's just reimbursing herself? The remaining $275,000 can be penalty-free, but taxable as ordinary income, similar to a distribution from an IRA. However, starting at age 65, in addition to qualified medical expenses that may have incurred, HSAs can also be used for health insurance premiums, including Medicare Part B and long-term care coverage. If we assume that's a $10,000 per year distribution, the HSA could fund her medical expenses tax-free into her 90s. Assuming a 25% tax bracket, the ability to withdraw $475,000 tax-free in retirement could save her family $120,000 in taxes. If the money was made into a traditional IRA instead of an HSA, the entire $475,000 would be taxable as ordinary income. Also, there's no RMD on the HSA. This allows you to withdraw as little or as much as needed to pay insurance premiums, but you can take it you can pay reimbursement. Man, I didn't know you could do that. See, I learn stuff all the time from folks. When she's 65, she's been making tax-free withdrawals as reimbursement for the $200,000 that she paid as medical expenses. She got the deduction on the front end, can take $200,000 tax-free. And then she can take the rest for qualified medical expenses that may be incurred. Can also be used tax-free and penalty-free to pay for health insurance premiums, including Medicare Part B and long-term care. No other investment account has tax-deductible contributions, tax-free growth, and tax-free distributions. If eligible to establish an HSA, all you need to do is make this retirement income strategy work is to save and invest through your HSA, pay out of pocket for your current medical expenses, and maintain your receipts. That's I like it, man. I did not know that. I'm a big fan. I like the pig with the barbells there. That's good stuff. That's good stuff, Eric. I wish you had a not a fee based planning service on assets under management, but good stuff. Good blog post, and I'll put a link in the show notes. So we'll see you later. Thanks, man.